Hi, everybody, and welcome to another episode of the Desi VC podcast. This is your host, Akash Bhat, and each week I speak with leading investors and operators investing and building companies in the diverse tech landscape of India. Today is yet another special episode here for us on the podcast. We have Chirag Gupta, managing partner at 8X Ventures, on the show sitting and talking to us about the deep tech landscape in India. Prior to founding 8X, he has held leadership positions at 500 Global, Careem, which eventually ended up becoming Middle East and North Africa's first unicorn, which got acquired by Uber for $3.5 billion, McKinsey, PwC, and Corn and Ferry. During these experiences, he has helped 10 plus corporations build their unique Startup Explore strategy. Chirag holds an MBA from the University of Chicago Booth and has completed his bachelor's degree in finance from Faculty of Management Studies. Today on the podcast, we delve deeper into the thesis that they have developed at the fund and, more importantly, understand the deep tech landscape from Chirag's point of view and where they're spending a lot of their time investing in some of the subsectors within the industry. So without further ado, let's head in and listen to our episode with Chirag. Chirag, welcome to the Desi VC podcast. It's an absolute pleasure to have you here on the show, and I'm looking forward to speaking with you over the course of the next 50 minutes to like an hour. Before everything else, how are you doing?
Thank you, Akash. I'm doing fantastic, and thank you for having us on the show. And just before this, I was talking about listening to your podcast, and I was listening to your podcast last night when I was driving back to home. And what you're doing is amazing. So good job to you. Kudos to you.
Thank you so much. Really appreciate it. Typically, when I have a deep tech investor come onto the podcast, I usually start off with one simple question. And I think I gave you a little bit of a hint of this as well last time when we spoke. The question is, how do you define deep tech? And the only reason I ask that is every investor that you ask or any founder that you ask, deep tech can be one of many things. The other day when we were talking about deep tech, we were talking about hardcore sciences and technology. And today we were talking about plant-based meats about 15 minutes ago before the recording began. So it's so diverse. You don't really know where, where deep tech really falls. But I also want to understand how you think of it from your perspective. And if I could also extend that question slightly further, I also would like to understand why deep tech. You had the option of being anything or agnostic, but you still chose deep sciences and deep technologies to be the sector that you're investing in. So if you could tie that story in along with the definition, it'd be fantastic for our listeners to understand where you're coming from.
Absolutely. So let me start with what is our definition of deep tech. Now, we see deep tech is a spectrum. And for the sake of conversation, I'll simply simplify the spectrum from 0 to 9, 0 being the easiest technology or some of the consumer tech, and nine being the hardest, most complex rocket science that we're talking about. Now, of course, you can say that a simple AI or a algorithm is also a deep tech. So which is probably a 0 or a 1 or probably a 2. And sending a human to Mars and like a one-way ticket to Mars is also a deep tech. That's probably 8 or a 9. But we group them in 3 components. One is a component which is easy to replicate, deep tech, which is probably 0 to 3. Second part is realizable deep tech, which can be achieved in the next 3 to 6 months or probably a year. But it's not that straightforward to copy because someone has spent probably 3 years or 5 years building patents. So someone has built a moat around that. So that's probably 3 to 6 years. And then there are parts which are lab tech, which are building in the lab, and it takes like decades of research to actually launch a product.
The moonshots.
The moonshots, right? So those are 3 broad clusters. Now the first cluster, which is a simple tech, we believe that most of the time simple tech can be replicated by 2 smart people within maximum 3 to 6 months. So the moat is not the technology, the moat is the execution, and the moat is the marketing dollars that you have from the VC. The second cluster that we talked about, which is probably the deeper tech, relatively deeper tech, typically can be replicated. However, because there are some patents around it, some IPs around it, so it takes anything from 1 year to 3 years to replicate. So technology is the moat. However, once you replicate the technology in probably 3 years, for example, making a car or making an electric car, for example, once you replicate that technology in, let's say, 2 years or 3 years, then the conversation becomes the same, which is a operational execution and the marketing dollars differentiate there. And then the third cluster is the lab tech, which is like a moonshots that you talked about, which can take decades, or you may not be able to replicate at all because there are so many complexities around that. So that is one area of the spectrum and one dimension of the spectrum. There is one more dimension to the deep tech. The other dimension is the market readiness to accept the technology. Now, before I talk about the dimension more, just think about it. When we were talking about moonshots, there are many biotech examples which exist right now, but the market is not ready for that right now.
Right.
At the same time, in the simple tech, there are some very, very simple tech like dog walking apps or an AI that tells you when your dog is hungry. Market is ready for that. So now the other dimension is how ready is the market to accept the technology that you're building right now. And most of the time, not always, the first cluster and the second cluster, which is a simple tech and slightly deeper tech, have a market which is relatively ready to accept or is getting readier to accept that. The lab tech is the one which take probably decades for the market to be ready. For someone like you and me, if Elon Musk says that he's going to send me to the moon, I it might sound great for 5 minutes, but once that feeling sinks in, I will be like, I don't want to go to the moon actually, or I don't want to go to the Mars. I want to live on Earth. So the market readiness is a different dimension for that.
Mm-hmm.
When we look at the deep tech, we only look at the cluster two of the deep tech, which typically takes 1 year to 3 years to replicate for the technology, and where the market is almost ready or already ready to accept that. So
Right.
something, for example, the plant-based protein, it takes about a year to replicate or build a new technology or a new product around that. And there are some patents and IPs around it. And the market is ready right now. If you tell me that Chirag, go to this restaurant which is providing plant-based seafood, I will go and try it. So the market is ready for that. Now, then the execution is the primary factor on that. And you can defend your technology using patents, but yes, within a matter of 1 to 3 years, it can be replicated. So that's the answer to your first question on how do we categorize the deep tech. And I gave a long answer, but practically what I said is basically it's a XY spectrum. The second question that you asked me was, why did we choose to do deep tech and why not do consumer tech or ed tech, which has been the common themes for the last 1 decade.
Right.
And given that we are the new VC player in the ecosystem, we should have gone with something easier and not something which is the hardest to invest in. And this is where a little bit of learning comes in. If I'm doing a ed tech, for example, or a consumer tech, what I said is that in the beginning of this podcast, for ed tech or consumer tech, your marketing dollars and your operational execution speed are your moat. There is no practically a product moat. I can copy some of the best ed tech companies from a technology standpoint in a matter of a week if I can sit down and code. So the moat is the operational execution and the marketing dollars. Given we are the newer player, newer VC ecosystem, if we invest in an edtech company and Tiger Global, Sequoia, or some of the bigger players invest in a competitor edtech company, they are bound to win. They can keep pumping money. They can squeeze us to the death for the next 3 years, very easily. We may be able to pump in a couple of $1 million, but very soon we will dry out and we will back off. On the contrary, Sequoia will be comfortable putting another $10 million just to make sure that they kill every potential competition and move fast. Now, given that we know that we cannot win against the bigger players, it will be foolish of us to try to compete with the giant armies of Tiger, TPG, Sequoia, and go head on against them. That is the first rationale that we had. Second rationale that we have is a conviction that deep tech investment is going to be the next big thing in the venture capital ecosystem. And let me tell you why. If you look at some patterns on how the deep tech, how the Asian ecosystem, investment ecosystem evolves, Asian investment ecosystem almost always replicates what is happening in the US and the European markets. Now, let's look at the US and the European market. Last year, about 30% of the VC money went into deep tech. Now, of course, we can argue what is the definition of deep tech, but that's a number given by different reports, and the number varies from 25% to 35% based on what report you are reading.
Right.
If you go to the European ecosystem, about 25 to 30% of the money went to the deep tech ecosystem. And this year, they have already announced $1 billion fund, €1 billion fund, and multiple other funds have come up to invest in the deep tech. Right now, if you talk to any of the VCs in the Europe, they will tell you they have more money to invest in the deep tech than quality startups they can find. So they have a different problem. Now let's talk about India, Singapore, and Middle East. India last year had 7% of the investment went into the deep tech ecosystem. Singapore had about 9% of the investment in the deep tech ecosystem, and Middle East was much lower. Of course, now we can argue by different reports. Different reports report India from anything from 5% to 15%, similar for Singapore, and Middle East is typically 5 to 10%, depending on what report you're reading. This number used to look very similar for the US about 5 years back. In the US, it used to be about 5 to 15% deep tech about 5 years back. But now it has changed to about 1/4 of the investment. And same for the Europe. 5 years back, it was about 5%, 10% investments were in the deep tech. And now about quarter of the investments are going into the deep tech space. Our conviction is that this trend is going to very quickly catch up to the Asian ecosystem.
Right.
That's the second rationale. Now, there's a third rationale to this. If you look at the Indian ecosystem, because there is limited money flowing in the deep tech space, deep tech in startups are very often undervalued. For generally someone who has spent like 4 years of research, come up with an amazing product, they are talking about a valuation of $3 to $4 million, and they have already done the market testing. They have already done a proof of concept. They have already done paid pilots as well. They are generally talking about $4 million valuation right now in India for a deep tech product. On the contrary, if you go to US and the European market, similar products, similar amount of effort put in by the founders, they are talking about anything from $15 to $20 million valuation. So there is easily a 4x to a 5x difference. Deep tech is one area. You can take the technology to a different country and you can start selling to the new customer, because more often than not, your customers are large-sized enterprises, oil and gas companies, governments, major food producers, industrial companies. Now, given that a lot of these players are big, you don't have to scale within a country. Typically it's not a B2C model. Typically it's a B2B or a B2G model. Now, think about this. If you go from an investment at $4 million valuation and you work with the startup to bring them to the European market or to the US market or to the Middle Eastern market, where the price point is a lot higher and the valuations are a lot higher, you can easily make the company $20 to $30 million valuation in a matter of 3 to 5 years. So you can very comfortably generate a 5x return because they have a good technology, the founders are good, and the founders have an understanding of how to run an international business, and which is where we come in, and we know that given our international experiences, we can help out the founders go into the international expansion mode. So those are three broad reasons we saw that it makes complete sense to start from the deep tech space instead of starting from a consumer tech or a ed tech or a shallow tech ventures.
I wanted to unpack three things in that segment that you mentioned, and I'll start out with this. You mentioned market being ready versus market being big, right? And you gave the example of, let's say, food alternate to meat we talked about. Now let's unpack that, because you said that market being ready. Yes, we have seen a lot of companies come out even in the Indian deep tech ecosystem as well as in the food ecosystem, where you are seeing a couple of these brands come out and selling direct to customers and directly selling to restaurants and other food players as well. Now, because there's a ready market out there, may not imply that it's a big enough market to begin with, right? Because the plant-based target audience, even in India, while it's growing, there is a huge perception when it comes towards meat in the country itself. So does that then mean, from an investment lens, this becomes a very difficult sector for you to be investing into? Or are you also looking at the potential that this company might have and thinking about exports and working with just companies outside of the country and consumption happening outside of the country versus consumption happening within, to really test out even if this is a good investment opportunity for you or not? So where are you when it comes to market being ready versus market being big within the deep tech environment?
This is a very interesting question. Let me answer specifically first to your question on the plant-based meat, and then I'll probably generalize this for other industries.
Yeah.
Now, plant-based meat is a slight exception, not an exception, probably a anomaly because it as you rightly said, it can be a B2C, it can be a B2B, and even if you go B2B, are you selling it to the restaurants? Are you selling it to the meat producers? Because the industry, the food industry as a whole, has always been and still is quite fragmented,
Right.
despite the growth in the industry, despite the bigger players that have entered the market, it
Yeah.
has always been fragmented. So even when you do a innovation in a fragmented industry, you will end up selling it in a very fragmented way, or you have your go-to market strategy will cannot be as brave as going to a oil and gas player or a big player and saying that, okay, this is the investment and this is the product, please help us sell, you're done.
Yeah.
um, and now plant-based protein is also complex in a way that the taste varies. What might sell in the Indian ecosystem, and very specifically what might sell in New Delhi, may not sell in Mumbai or Chennai.
Right.
And if you bring the same taste of the same product to San Francisco, it may not work
Right.
because the palate is different for people. So that industry itself is very different, is an anomaly in the deep tech space, I would say. And when you said market being big versus market being ready, I would say that market is ready for the plant-based meat in most parts of the world, but the market is not big enough right now, primarily because the ways of operating for every restaurant, for every shop, has been set and established over decades. So
Right.
they have learned the rules of the game of how to attract and retain their customer over decades. And now suddenly changing for the existing restaurants or existing shops, probably a bit risky. They might start introducing it in their shops or the grocery stores, but they may not want to push it against the products which are already like a cash cow for them.
Right.
So that will be too much risky for them. However, then when the new restaurant opens, it has, I would say that there is a possibility the newer restaurants might experiment a bit more, But let's think about what is the proportion of the newer restaurants. My assumption is less than 2% or less than 5%.
Yeah.
So the market is ready in this case, but is the market going to scale up really fast? I don't think so. It's going to take a while because before the market can scale really fast.
Yeah. Does that then also pose a threat? Sorry to interrupt you, but then that got me thinking, right? If the price, so the pricing is also another different thing to address here, and in my opinion, a huge constraint, because when you think about plant-based meats, right now the current market price is slightly more expensive than regular meat in itself. And while the price can only go down if there's larger consumption, therefore bringing the cost down, or the startups need to continue to raise money to fund the research, and that research in turn giving substitutes to existing raw materials, therefore bringing down the production costs and therefore the selling price as well, knowing that there's a hefty margin still left in between for the company or the players to operate on. Now, that's a huge challenge because there's never going to be an adoption in the early days at scale to hit those numbers, which basically means you're constantly raising money as a startup. But that, going back to the earlier point that you made, which is trying to be very thoughtful investors in the early stages, does that then also go against your thesis where while you may back a startup at the early stages where, $3-4 million valuation, but it has to continue to keep raising money at every stage for it to actually even hit that point where the technology becomes affordable? And in this case, in the example that we're talking about, it's the raw materials of the plant-based meats, the research, all of that, bringing the ingredients cost down so that the final selling price to the consumer is affordable, so that it at least replaces existing dal chawal perhaps that somebody's eating for their carbs and proteins, and therefore substituting the dal with maybe a plant-based meat. So how do you think about that situation where you're almost against the thesis in one way?
Not really. And this is a very interesting question. Almost all deep tech companies or where the technology is defensible, but it's not like a lab technology, they will require a continuous flow of money for R&D.
Right.
And I'm not saying for all, but for a lot of them, because they have to stay ahead of the technology curve because technology is their moat.
Mm-hmm.
Uh, the other things are probably not their moat.
Mm-hmm.
Now, you rightly pointed out that you have to keep pumping in R&D money. So now, when we go in, what is important is that we have to make sure we are not the only investor coming on the cap table. We have to come along with at least one other investor who has the capability and interest to keep funding for the subsequent rounds and also have the brand reputation to attract other bigger investors at a subsequent rounds. So,
Right.
for example, one of the deals that we are doing right now is with a player which often invest up till like a pre-series B from seed stage. So we do seed to series A, and we know that they do up till pre-series B, and we also are privy to the fact that they are exploring a series B fund right now.
Okay.
And we are also privy to the fact that they have spent about 6 years building their brand reputation in the ecosystem, that when they invested a Series A, they are able to attract other credible investors on the cap table. So it's very important that when we go in, it's you have to we have to bring in one or two other players together with us,
Yeah.
uh, who can keep funding the R&D.
It's a very good point.
However, there has to be a conceptual alignment that we are funding the company because we want the technology to be the moat, and we do not want to work with a VC which are used to the consumer tech and that starts pushing the startup that, okay, go into the discount model and start discounting for the next 6 months, and probably like a SoftBank. So, of course, I would love to do a deal with a SoftBank, but that's a SoftBank way of doing things, which a lot of people have replicated.
Yeah.
We personally do not want to work with those VCs. We want to work with the VCs who understand the deep tech life cycle.
Okay. That's a very interesting point there, because brings me back to the original thought that you shared, which was around competing with other VCs in a very crowded space, right? You took the example of a Sequoia operating in, the agnostic space where they're investing into every sector possible, and they have both a pre-seed seed stage fund as well as the growth fund both for the Asian markets and the European and US markets. Now, do you ever foresee a time where there may be a, a large investor entering the early stage deep tech space? And I personally feel it won't be long. It probably is about 3-4 years away, at least from an India context, until we have like one clear breakout winner come out, which probably will take the next 3 or 4 years, where there's enough conviction for a large investor to come and say, hey, we'll set up $100 million, $150 million fund, wherein we'll take on the smaller guys, but we also want to get a small pie or a large pie of the deep tech cake. Do you foresee that happening? And when that happens, what is your reaction? Like, is that good? Is that bad? Does that make the space more crowded? And would that still be motivating you at that point to take on the big players who, I mean, call it greed, call it opportunity, call it whatever it is, may end up posing a threat to all the incumbent deep tech VCs?
First of all, this is already happening. It's not
But
the
it's very
future.
selective, right?
They're selective, but it is starting to happen. There
Okay.
are big funds where they have started allocating money for the deep tech investments,
Mm-hmm.
including what I've heard, and not from very credible sources. Sequoia has also allocated $50 million from their ongoing fund to
Mm-hmm.
do deep tech funds at C to Series A.
Mm-hmm.
Now, I don't know if it's accurate or not, but yes, if $50 million is not accurate, maybe $20 million may be accurate.
Okay.
And there are multiple funds. Because we talk to Indian Venture Capital Association quite frequently, and there are quite a few funds that have either entered the space or the bigger players who have started redirecting some money into the space.
Mm-hmm.
Some of the established players, let's talk about Excel Partners, for example, which is a very credible big player. They have started coming as early as pre-seed now as well. So they
Okay.
launched a program called Atom,
Yeah.
which targets startups at the pre-seed stage. So it is starting to happen. Having said that, our view is that the ecosystem, the startup ecosystem, the deep tech startup ecosystem in India is huge, and it's massively untapped right now. Our view is that the amount of investments required. So, and last year was what, 200 or 300, 300 startups were in the deep tech were invested in India right now by big VCs. But if you look at the number of deep tech VCs coming out right now, just from IIT Chennai, which is one of the flag bearers of deep tech investments, there are 200 startups, deep tech startups sitting in IIT Chennai, just in one city.
Mm-hmm.
Now, let's assume for a second that others are not as good as IIT Chennai, and the number is much lower. Our very conservative estimate is that they are at the bare minimum 1,500 investable, high quality deep tech startups in India right now. And right now, with the current financial allocation or the money allocation by the bigger and the smaller players combined, we cannot fund more than 500 to 600 deep tech startups right now.
Mm-hmm.
So the number of startups is way bigger, and there is a lot of opportunity. There's one thing that you said that I want to disagree with. You said it's a matter of time when a deep tech unicorn will come out. There are already two deep tech unicorns in India. One is called Gupshup, which came out from IIT Bombay, and one is called Uni4, which came out from IIT Chennai. And they both have done amazingly well. I think they are some $2 or $3 billion valuation right now. And they have actually managed to divert a lot of attention because they did exceptionally well. They grew from a $3 million company to roughly around $3 billion company, each of them right now, within a span of 5 to 6 years. So that has given a clear motivation to a lot of startups. The bigger threat for us that I see are the European VCs. Now, European VCs are starting to enter the Indian market because Europe in particular has more deep tech investment money than the number of startups that they can invest in. So now, by default, they have to explore new markets, and India is one of the markets that they're exploring, not very actively, but some of them have started looking at it. Now, this is where we have to carefully, for us particularly, we have to carefully partner with these deep tech VCs to, instead of competing with them, let's work together because they also need quality deal flow. We also need quality deal flow. In and they also need co-investors. It's not the case that they can go alone. A lot of them don't want to go alone as well. So they also want some other VCs who have presence on the ground and have understanding of the Indian ecosystem want to come on board. So yes, in some cases I do feel threatened because some of the deals close faster than I would have liked, or even before I am starting to think about them, they are already gone. But at the same time, I also see it as a great opportunity. The more players enter the market, the easier it gets for us to find co-investors. The easier it gets for us to exit eventually in 3 to 5 years or 5 to 7 years, which is
Right.
the timeline of the fund.
Yeah. No, that's a great point that you make. And just a clarification, I meant a couple of winners coming out of the deep tech space rather than not mentioning just the unicorns. A unicorn is a great story. It obviously gives a lot of people conviction that the space is growing. But I'm talking about real winners going out, maybe listing themselves on the public markets, or a huge acquisition taking place in this industry, which really hasn't sent ripples across, the investors' tables to shake them up and say that, hey, you've got to be looking at deep tech, and India is a budding playground for that. And I believe that's going to happen in the next couple of years. But coming back to one of the earlier points that you made as well, and that got me like thinking about, the valuations between Indian deep tech companies and their counterparts here in the United States, or, we've been talking about European markets as well. The point that you made were Indian deep tech companies can be more affordable to a VC at a $3-4 million valuation versus something out here, which probably is 4 or 5 times that valuation at between 15 to $20 million. Now, my question to you is, why are Indian deep tech companies undervalued, or do you even see them as being undervalued? Or are they just being pragmatic and realistic, given, as you mentioned, sometimes the market may not be present. The technology is the moat which is yet to develop, but it's all just very the theoretical at this point. So why do you feel it's undervalued? And do you maybe I'm also spoiling a couple of founders by asking this question to you. And if you disagree with me and you say they are being undervalued, you might be putting yourself in jeopardy. So it's a tricky question. But I still am very curious as to why Indian deep tech companies are undervalued severely compared to their counterparts in Europe and the United States.
This is a very difficult question to
Yeah,
answer.
it's a catch-22 for you, because if you say they are undervalued, the next time somebody comes to you, they're probably coming with a bigger valuation.
That's true. So uh, let's go to the fundamentals. What is the right valuation for any company? Let's say someone who has come up with a plant-based protein. What is the right valuation for that? And now someone whose product is ready and is pre-revenue in US is probably $11 million. In Europe is about $8 million. In Middle East is about $9 million. In India is about $3 million. So then the question comes, what is the right valuation? And even though I want to pretend that I know the answer, that what is the right number, the reality is I don't know what is the right valuation. We look at it from a relative standpoint, and from a relative standpoint, we do see Indian market is undervalued. And when I say undervalued, relatively, there are two dimensions. One is comparing with the deep tech startups in the Europe and the US market,
Yeah,
and comparing them to other startups and other consumer tech startups within India itself.
right.
So when we do two comparisons, in both the comparisons, deep tech startups
Fall
are
short. Yeah,
definitely undervalued.
yeah.
And but now your one nuance of your question was, should they be at a higher valuation? I I think maybe yes, but not up till Series A. And that's because a lot of deep tech startups, unlike the consumer tech where people are more familiar with, a lot of deep tech startups do not have much, or if at all, any revenue up till Series A. They have
Right.
very little to no revenue. Now, unlike a consumer tech, by the time you hit a Series A, you already have a pretty decent amount of revenue flowing in. So based on the absolute numbers, you can run your multiples and do the valuation.
Yeah.
If you talk about biotech up till Series C, you have no revenue.
Right.
So it's a it's very difficult probably for the deep tech players which are pre-revenue to be able to defend when they are negotiating with the VC
Yeah.
um, a high valuation.
But revenue isn't the metric here, right? When it comes to evaluating companies, because I gave you the example of my first ever investment being in a deep tech renewable spaces. Now that company has gone on to raise Series B till date, but they're still pre-revenue. They don't have any customers that they're working with at this point. But because they're a battery technology company, at every point their competition is whoever else is building a battery technology company out there and understanding whether they're bringing the efficiencies higher, bringing down the cost of improving the product efficiency. Let's put it that way. And for them, if the battery costs $132 at their seed and they're able to bring it out to 118, that is one of the metrics that they would actually consider to be a success. One of the metrics before they go out and raise the next round. So they're constantly trying to bring down the cost of production so that at a possible point in the future, there's going to be mass adoption of their technology. And that is probably also one of the reasons how later stage investors may look at this, may look at what's happening out in the market, what other competitors exist in the similar space, and also the application, right? Because it could be commercial application, could be consumer application. Depending on all that, the pricing probably varies, and the metrics also then are evaluated in a different way. So, is it fair enough for us to look at deep tech companies from a revenue point and then evaluate whether they're good or not in terms of a valuation point of view, or should we have a different metric altogether, or is it also case by case depending on which sector these companies are coming out of?
So first of all, it is case by case. But the reason I talked about revenue is because the moment you say you're pre-revenue, you actually have closed door to a lot of VCs.
Mm,
And now venture capital or funding in general is also a demand supply game, and the negotiation is entirely a demand supply game. The moment you say pre-revenue, the less number of VCs are available for you to talk to you, which means that you have less negotiating power as a startup. Now, when for the bargaining power for the VCs shoot up drastically when they know that they are the only players talking to them, or they are amongst the very few players who are talking to them, or are even open to having a conversation with them. So, so that's the reason I said revenue. But you're spot on. It's not the right metric. Doing
right.
a You cannot, especially when you talk about biotech or a space tech, for example, you just cannot calculate the valuation of that particular startup based on what is the revenue right now or what is the revenue going to be.
Yeah.
And you raised a very relevant question, which we talk about internally all the time, and we still don't have a good quality answer to, is what is the right metric then? If revenue is not the right number, and we are talking about the future potential impact of the technology and all those things, but how you will quantify that, Akash, versus how I will identify, how my partner will quantify that. The quantification of the value of the technology is different for different people.
Right.
And that raises that sometimes makes it very confusing to come up with a number which is sensible and where you have a conviction.
Yeah.
So so even though I would like to say that, oh, I know the sector and I know how to do the calculations and I know the valuation and our team is exceptionally smart, the reality is these are the questions that you are asking. We talk about it internally all the time, and every startup we are doing, we look at relative valuations which are happening in the market. And sometimes, even after relative valuations, we are ourselves are not convinced that what is the basis of this relative valuation. Maybe the three other deals that happened in the market in the last 6 months were delusional. Maybe they were lost on, and how did they come up with this number? This makes no sense.
Yeah.
So, unfortunately, I don't have a very solid answer, which I want to have, but I don't know if anyone else has that.
Oh, that's a great point. I don't know if I have a clear-cut answer there either, because I definitely feel it differs from industry to industry and how you look at it in the context of time as well. Because today we might be talking about one industry in the light and say we probably might be talking about a $3 to $4 million valuation here from an Indian context, but maybe 24 months from now, it's a different market altogether. And we're perhaps talking about a $6 to $7 million, or maybe even a 10 to 8 million, $8 to $10 million valuation in a different market. So we don't know what happens because there's a lot of other factors that also come into place, and at the same time, competition, how the market develops, macroeconomic conditions, just the deal activity within the deep tech space. All of that really has an impact, in my opinion, at least. So definitely an interesting question to pose every deep tech investor, I guess, to find out how they are also thinking about it, and if somebody at least has an answer, which I don't think most people will do. I think it's just an evolving thought and perception that most people will have as time passes. And that also brings me to a point that you made previously, which I think was really, really interesting, because I intentionally asked you whether you would be a little skeptical if the growth stage bigger VC funds from outside of India started operating in the early stage deep tech space. And at the same time, I also posed the question to you regarding the undervaluation of early stage deep tech companies in the country. Are you somewhat fearful, or is it a missed opportunity for Indian funds that we are not valuing them at the price that we probably might value an external company that's based in Europe or the United States, and stand the risk of these big VC funds coming in and then valuing these companies at the price that they should be, and therefore at that point feeling that the market is overvalued? You see what I mean?
What you
Because
said is exactly our investment thesis, that we have a very strong conviction that it is a missed opportunity. By not doing that, actually, if you don't do this, and if you don't see this opportunity, which is so evident to me from day one of this company,
somebody else will.
somebody else will. And there
Yeah.
are players in the market, and I'm not the only one. If you talk to Kalari Capital, Ankur Capital, Your Nest, GrowX, they are all banking on this opportunity, because there is a very, very clear, and if you think about it, it's almost like doing a arbitrage in the public market, where
Yeah.
you buy from one country and eventually you figure out how to sell it in another country, because there's a price arbitrage. There is an arbitrage opportunity. You just need to go out and identify it. So
Mm.
yes, 100% aligned with you.
That's one of the things that founders look for, right? Because they're looking for a fair game. They're looking for an investor who believes in what they're doing, gives them the right valuation, at the same time can offer the support and everything else. And unfortunately or fortunately, we're in a price sensitive market, and in price sensitivity here is towards the higher end, unfortunately, and not the lower end. Wherein whoever gives you a better and bigger term sheet, you're more likely like to take it. But at the end of the day, the smartest of the smartest founders will probably think hard about any term sheet that comes in, which values them above and beyond what they should be, knowing very well that if they don't hit certain metrics, they're setting themselves up for failure. Next time when they go out to raise, it's going to be a down round, and no one's going to be happy, including them, including their investors. The only one who's probably laughing themselves at the bank at the next round of investors, who probably will value them at what they should have previously been valued, or even maybe under market valuation. So you're definitely going to be losing that game
Hmm.
if the valuation game is not up to point.
The only point where I potentially disagree with you is when the down round happens, do the VCs cry about it? And something which, and this is my opinion, not a proven fact yet, not always. A lot of VCs, including us, we work on anti-dilution clauses, and we have so many clauses in the term sheet. When the down round happens, actually the people who lose the most are the founders.
Other founders, yeah.
It's actually not the VCs. We'll figure out a way to have more equity in the company.
Yeah.
We'll try to find ways, and especially in the deep tech space, where your negotiating power is way more than probably in a consumer tech space.
Yeah.
You're so well protected as a VC. The only risk that you hold is that, are you going to dilute the founder so much that he or she will actually lose interest in the startup itself and walk away? Because
Yeah.
that's the only risk. But other than that, generally when the down round also happens, VCs are more often than not a lot protected.
That's a very good point that you made, and that's a different perspective to looking at valuations, right? Because obviously, when you look at it from a founder point of view, it really sucks. It really sucks that you rode the wave when it was high, but then you unfortunately didn't achieve those targets that the VCs and the industries felt that you would, and now you're unfortunately bearing the brunt of it, while everybody else around you, as you mentioned, can benefit from it, can also at the same time not make it. It again brings a good point up here, Chirag, because you talk about anti-dilution clauses, you talk about the fact that the VCs can actually end up benefiting. But is that also true? Because when dilution happens, the founders are the ones who take a big hit, right? But at the end of the day, as an investor, I also want to make sure that the investors have enough to come and have that motivation to work next day. So if the dilution is also like large, you're kind of like also then not incentivizing the founders to like come and have skin in the game. It just becomes a job to them at some point, and that's just again recipe for like failure. So how do you look at it from that point of view, while benefiting it but not benefiting as much as you probably could, while also making sure that founders are incentivized to come back the next day and start working?
So when we run our numbers, I we personally we have to make sure that the key founders, probably two or three people combined together, at any point of time in the foreseeable future should not have less than 15 to 20% equity. So when I say foreseeable future, I mean even preparing for the next three subsequent rounds. If we give them a term sheet or squeeze them in certain shape or form where we can see them going way below 15-20% of equity in probably by Series C or Series D, or by the time the IPO happens or M&A happens, then we know it is going to happen. What you said, like it becomes like a job for them and not really ownership for them. It is bound to happen. So we are very, very conscious of not diluting the founders way beyond a certain point.
Okay.
And in fact, we have actually walked away from the deals where the founders were undervaluing the company too much just because they wanted the VC to give them the money.
Mm.
And they were so undervalued, like a $2 million valuation, and they need like $500,000 or more in some cases. The technology is amazing, the product is amazing, what they have done is amazing, but they're just desperate, so desperate for money that they have reduced the valuation drastically just to make it very attractive for the VCs.
Yeah.
We have walked away from those deals. We have told them that, guys, what you're doing is absolutely stupid, because
Yeah.
sooner or later it's going to come back and bite you. So yes, as a VC, even though you can benefit from a lot of clauses that you use, you have to be mindful that the moment you will lose the founder's interest and the emotional connection between the founder and the company, the moment that is gone, the emotional connect is gone.
Yeah.
That piece of paper that we hold as a VC is worth nothing, actually.
Agreed. Completely agree with you on that point. It's very important to keep the founders motivated up until whatever the exit scenario is, going IPO, getting acquired by somebody else. They need to be motivated, have skin in the game, and not
I have to,
just pure passion.
I have to add something here. I worked in a company called Careem, which is right now a multi-billion-dollar company acquired by Uber.
Yeah.
And I have always been very influenced by the CEO, Mudassir Shekhar. I don't know what percentage of equity he owned in the company when the IPO happened. I don't know. But I realized and learned from him that the game does not stop at the exit.
Mm.
So he could have walked away on 2nd January 2020 when the Uber acquisition was completed. The Kareem was valued at $3.1 billion. And he probably could have done a lot of things to have a better life. But I realized that he was so passionate about, and he is so passionate about Kareem, and you can see it in his eyes when he talks about it. So when you say that, or when we say that the founder has to stay excited till the exit at least, I see Mudassir Shekhar as the benchmark in my head, that the founder has to has that level of passion for the startup, that irrespective of what happens to at the exit, I
Yeah.
am gonna be there. and I'm going to be there after that. I'm going to be there like when people will write up the history for this company, they should be able to say that I changed the ecosystem, I changed
Yeah.
the industry, and I changed the economy. So when the founder has that level of conviction, then nothing can beat that. But of course, you have to protect the founders.
Yeah. No, it's a fantastic point that you make there. I completely agree with you. And that brings me to this last segment where I wanted to delve a little more deeper into some of the sectors that you've actually fallen in love with over the course of the last few years of investing in the deep tech space in India. Maybe perhaps you could draw an image for us about sectors that you personally are really bullish about investing into and the ones that have really done well for the fund, as well as the opportunities that India presents in the larger context of the deep tech space going forward, looking maybe 5 years into the future. Where do you see India on the world stage? And at the same time, what is required for us to perhaps even achieve those targets if they're ambitious?
Absolutely. So I'll start with the sectors we are bullish on. So there are two deep tech sectors. One is the clean tech, which includes water, sanitation, hygiene. That is clean tech. And second is Industry 4.0, which includes solutions to transform your manufacturing or your oil and gas, your construction. So those are the two sectors where we are exceptionally bullish on, because India traditionally for the last centuries were like had a lot of manual labor. But now, as a country, we are starting to be a lot more educated, and everyone that you meet wants to have an office job or a job where they don't have to carry bricks. There's less human effort, and they are it's the machinization is a lot more. Now, these two sectors are actually changing the way India will look in the foreseeable future. And the products that these industries develop in India are relevant for the on the global stage as well. So, for example, in the Industry 4.0, one of the startup we have invested in, it's called Zyma. They they help improve, they help track the heat and viscosity of fluid moving in the oil and gas pipelines, especially at the manufacturing stage. It's a very critical product, not just in India. It's manufactured in India, it's built in India. But imagine having a 99% accuracy versus the current 90 to 95% accuracy. The level of accuracy is way higher to measure heat and viscosity. And it's an Industry 4.0 solution. It is going to change the way oil and gas operates or looks at the pipeline systems. So because these products in clean tech and Industry 4.0, whatever you build for India can be sold globally. So those are two sectors we are very bullish on. Other than that, we see India having a strong play in a few other sectors. One is where we look very carefully on, which is smart mobility and smart logistics, which includes drones, which includes your electric vehicles, um, um, and a few other technologies around the smart mobility and smart logistics. Drones in particular, because India is protected and you are not allowed to import the drone technology, the kind of technology India is developing in the drone space is mind blowing. There's a company called eSpace in IIT Chennai again, where I think uh, your Nest is one of the key investors, or Speciale is the key lead investor over there. Speciale Invest guys,
Yeah,
and it's a great product what they
it
are
is.
building right
I
now.
saw them when they were in their pre-seed stage. Yeah,
Yeah, so once they build that product, actually you can sell it globally.
yeah.
There, there are few drone companies like Bonwheel that are solving for the issues of hilly transportation of equipments at the hilly or mountain areas.
Mm.
Now, and there are a lot of technologies coming around that. The other sector where India can actually make a big difference is the biotech and the health tech space. The amount of startups and research that is happening in the health tech biotech space just it's just mind blowing.
Mm.
And the quality of research and the quality of work that they're doing is again mind-blowing. The only part where India will have to figure out is how they are going to compete or get recognition on the international platform. Because if you want to talk about health tech and biotech, unless you have a FDA clearance, for example, the no US company would want to talk to you without US certifications. And right now, the US certifications are so powerful that if you have those US certifications, you can actually sell in India also. People are a lot more open, or in most part of the Asian countries, people are a lot more open exploring that. Indian economy will have to figure out how to reverse the game, how the certifications and the patents in India become as valuable of selling internationally. If they manage to figure that out, we strongly believe that actually the biotech and health tech can actually bring India to a global platform. So is the drone technology.
Mhm. No, they're very interesting points. And I completely agree with you when you make cases for both clean tech and drone technology or anything that's got to do more so which helps in the development of the infrastructure, because I think that's also where you'll get a lot of support from local governments as well as the central government in ensuring that there's opportunity given to like local players in expanding this adoption. And in fact, there'll be a push from governments to ensure that there is much more availability of this across various geographies within the country, allowing both commercial operations to kick off at a point and at a scale where, like you said, we are positioning ourselves for global domination, or even, we can be compared to maybe a competitor in a different country, different geography, and say we're perhaps at the same level. Now, lastly, before I let you go, and I'd be remiss if I didn't ask this, is what are your thoughts and advice that you probably want to give in, founders who are building companies today in the deep tech space or are thinking about coming up with companies in the coming future? What's your piece of advice to them in terms of both building the company as well as thinking about the fundraising journey?
So there are two advice. First is for the building the company. When you are building the company, think about how you're going to change the industry and the overall economy as a whole.
Mm-hmm.
Because when you start looking at it from a very macro perspective, and if you're not changing the industry and economy in a deep tech startup, you probably are not doing a very good job.
Mm-hmm.
So the problem that you should be solving should disrupt the entire industry the way it operates, or the entire economy the way it operates, or at least should aspire to do that.
Right.
So that is for building perspective. The advice for fundraising perspective is look at how you now or in future can actually dominate the global market, not just the Indian market, and talk about that very candidly, openly, and research on that. Read about it, talk to people. You may not have all the information, but once you start talking about it, sooner or later you will figure out. But you need to aspire for a global dominance. Talk about how this will be a multi-billion-dollar company in the future, because the technology is exceptionally powerful and the way we're going to sell it is exceptionally powerful. The roadmap is exceptionally powerful. Every deep tech VC loves the story when you talk about global dominance. VCs are not very excited about a city dominance, or in some cases they're excited about national dominance. But deep tech is one space where you should always be talking about global dominance when you go out for the fundraising, and that will make you stand out.
Well, these are great nuggets of wisdom and advice that you're giving founders here, Chirag. Thank you so much for your time. I really had a fantastic time, and the way that you were pushing me as well in some of those answers kind of kept me thinking on my feet. I was pushing myself, and like I was saying before, even the recording, right? I've learned so much by speaking to deep tech investors, and I think my biggest learning has come about by seeing some of the best investors in India do some great work. Over the course of this conversation, right, you took me on a journey myself of when I started looking at deep tech to where I am right now, and making me think about various things and how I look at the space in general. So I'd like to thank you for that, and I appreciate you being on the podcast and sharing your time with us.
And thank you, Akash. Your questions are very deep, and the amount of understanding that you have is incredible. I really enjoyed this conversation. And I'm not saying just for the sake of this recording. I genuinely enjoyed this conversation before the podcast and during the podcast. So thank you for your time as well.
Absolutely my pleasure. Well, that unfortunately brings us to the end of this episode. Thank you each and everybody for tuning in and staying all the way towards the end. I had some fantastic takeaways from that episode, and quite notably, Chirag was able to delve deeper into the landscape and provide a complete overview about what deep tech investing in India looks like, and more importantly, certain metrics and evaluation criteria that VCs look into before investing into deep tech industries. Thank you so much, Chirag, for spending some time with us here on the podcast and sharing your insights and wisdom with us and all of our listeners. Now, if you're like me and you enjoyed this episode and all the other ones that we've been bringing you so far, please go ahead and rate and subscribe to our podcast on your favorite podcasting platform. Primarily, it helps you get notified every time we push out a new episode, but more importantly, it also helps others discover the show. Thank you for tuning in for the 93rd episode. Please make sure you tune back in again next week, as we've got a great bunch of episodes lined up here in the lead up to our 100th episode. Thank you again for all your support, and until next week, keep hustling and stay safe, everybody.